Hey guys, how's it going? It's Andy from MagooInvesting. Welcome back. Yesterday we talked about what I thought was probably the best IPO of 2019, and today we're going to be talking about the best stock on Robinhood, according to their analyst rating. And so I was kind of searching for stuff to do, kind of looking for companies that were kind of jumping out to me, and this is one that has a 100% buy rating on Robinhood, and I looked at the charts and my first thought was, okay, I kind of like this. So in this episode, we're going to be talking about Glu Mobile, ticker symbol GLUU. This is a mobile game company out of the Bay Area, which is where I'm at right now. And so it's kind of flown under the radar for me. Growing up here, I knew that Zynga was here, and I've talked about that in a prior video. If you want to see that, I'll put that up there. And GLUU is another video game company out of the Bay Area, and they've got super popular games like, okay, maybe not that one, but they have the mobile version of Diner Dash, which is a very popular game. And so it seems like they've done very well. In the past year, it's gone from around $5 up to $11. And after two bad earnings reports, the stock is back down to about $5.80 right now. And so in this episode, I'm going to analyze the charts, tell you what I see about there, and then talk about what I think may be the best long or short-term potential plays with the stock going forward. As always, I'm not a licensed financial advisor, so I'd highly recommend talking to a professional, someone that can find you the best places to put your money going forward. So as we talk about Glu Mobile, God, I hate saying that word. I'm just going to call it Glu from now on. So talking about the stock overall, this kind of is one of the examples of why I hate earnings reports. And so in the past, this stock has been hit by 2 days where in after hours after they reported earnings, they fell 20%. And it's not because, they came out and had this horrible event where they didn't make a lot of money. It's just they kind of underperformed compared to what the market thought it was going to do. And so having 2 days where the stock has fallen 50% from its highs, it's been profitable and it's just not been doing as well as the market thought. So I think valuing a company like this, I think it's very attractive. The stock had the track record of a lot of gains over the past year, 2 years, and since then it looks like it's at a great discount. On this channel, I talk a lot about buying stocks that have been hit by bad earnings or bad news recently, and it's not just a steady decline. And I think that GLUU might be a great example of that. After the stock fell 20% after August, the stock has been recovering very well, and it's in a very nice upward channel. And so let's hop on over the computer and talk about GLUU, ticker symbol GLUU. All right, so here we are back on Robinhood as always. Yesterday I kind of got distracted while looking for this video to make, talking about the most recommended video on Robinhood. I kind of went down and I was like, let's see, where is it? Luck and coffee. I was like, oh, I like coffee as I'm sipping on my fourth cup of the day. But today we're going to focus on what we were coming here to do. And we're going to talk about Glu Mobile with a 100% buy rating and 36,000 people owning it on Robinhood, which is pretty popular. As you can see on the day, it's up 1.5%, pretty solid. 1 week, it's up 12%. Kind of the reason it came up onto my radar is I was looking at top movers for the week, and I think GLUU was on here. 1 month, it's down 1%. 3 months, it's looking pretty good, up 25 or 26%. 1 year, down 17%, and then 5 years, this is where it starts getting interesting. You can see the track record of it pushed up to about $7 in 2015. It fell, it started building a support, pushed all the way up in April of this year, and then has fallen sharply and has started to recover. So as someone that loves taking advantage of companies that are hit by bad earnings or bad news, this looks very nice so far. So as we come down here, we can see that it's got a market cap of 832 million, and let's compare that to Zynga, which is going to be a trend. Oh, I don't want the caps lock. Zynga, there we go. So that was 800 million and then 5.8 billion. So obviously the difference is very apparent between the two. You also have 121,000 people owning it on Robinhood. But let's go take a look at the charts, kind of the thing that I'm looking for the most. And so we're going to start out on the 180-day 4-hour chart, which is my favorite one to look at. I have it kind of zoomed in right here because I wanted to point this out first. And this is the very nice upward channel that it's had ever since it had its recent lows. And it's kind of steadily been going in here. One of the things I really like is the fact that after it missed on earnings, it pushed down, hit the bottom of the upward channel, and then immediately recovered. That's always a good sign when the big move down gets bought back the following day. Always a good sign to see. So when we go back to 180 days, you can see how far it's kind of fallen in the past 6 months from a high of around $12 and now it's sitting around $8.50. Or I'm not dyslexic, $5.80. As we go back further, you can see kind of what we talked about on Robinhood, how it built a support down here around the $2 mark and steadily pushed up over the years up until April. And then it fell from bad news, 20% here, fell, kind of built a support and was chugging back up again, and then bad news again, and it's back to where it is today. So when you kind of come back here and you look back, you can kind of see the pattern of it pushing up probably higher than it should have been and faster than it should have been, and then getting hit by missing earnings and kind of building a support after that. So that's kind of one of the reasons why I really think that this is an attractive play for a swing trader or a long-term investor. You have the track record of it pushing up, and it seems to be doing very well ever since the recent news. I would kind of be worried about the next earnings, just kind of how it's done in the past. But this move down after the earnings and immediately getting bought back makes me feel pretty good about the stock overall. Also, I would be excited to see a golden cross if the 50-day ever crosses the 200. Kind of the problem with that is with the pace it's been moving, you're going to be missing out on a decent percentage if you wait until that happens. So kind of overall, my analysis from the charts is I like this upward channel. I think it's very attractive, and it's respected the top and the bottom very well. I would be looking for my price target to be a gap fill. So I'd be looking at to go to, oh, look at that, exactly the $7 mark. And so from where it is right now up until that, let's draw it from here because TD Ameritrade is frustrating. So that'd be a 16% gain, and that's a very nice trade. I've seen that the price estimates and the analyst ratings have been between $7.50 and $8, and so they think that the stock still has room to go. Obviously, they're not predicting it to come back up to its recent highs of around $12, but a 15 to 20% trade is very nice. That's nothing to complain about. So overall, I think the long-term trend looks good. I also think a swing trade up to the gap fill here, also an attractive play. That being said, let's head on over to CNN Money, which is where we like to hit first. And yesterday, when we looked at Luck and Coffee, it had the old CNN Money, and now we're back to the old one, or back to the new one. So here's the year-to-date of it down 28%. As the type of trades that I like trading, no, that's just a horrible sentence. The type of stocks that I like trading, it's very attractive seeing it this close to its 52-week range, but it's also pushed up from there. So it doesn't look like we're catching a falling knife. It seems like the support has been built and there's room to go to the upside. As you can see, it's up almost 13% in the past 5 days. All of the earnings growth over the past years have been positive. Earnings growth this year is up almost 160%, which is very nice. Earnings per share this quarter, 8 cents, which I think is much better than I think they had 2 cents. Or no, they missed minus 3 cents. So that would be a nice improvement. And then the forecast is very bullish overall, with the low end even being positive and the upper end being $9. And so I kind of agree with them on the median of $7.50. I was kind of more conservative, thinking around $7 for the gap fill, but I could absolutely see $7.50 being a reasonable price estimate for the next 12 months. When we go to Yahoo Finance, I never understand how their analyst recommendation compared to this works, but they have it as a sell, overvalued, but then up in the short, medium, and long term, with their 1-year price target being very similar to what I'm thinking of $7.44. So when taking a position in something like this, I like to wait for the support to be built, and it's done that. It's had a upward trend going, and there's a very easy to read area where I'd be willing to take profits. So that's a very attractive. Also, if it bottoms out of this upward channel, that's where you cut your losses. So I love the fact that it's got a very set in stone where to cut losses and where to take profits. So overall, I'm liking the stock a lot. And so overall, I think that GLUU is very attractive for pretty much any type of investor. You want to day trade it? Sure, it's got the volatility for that. You want to swing trade it? It's got the pattern of being in an upward channel right now. You can go for that. Also, I think the long-term outlook on the company is very bullish as well. Most of the price estimates that I've seen have it sitting around $7.50 or $8. And going from $5.80 to $8 would be an incredible return on a longer-term trade. So it's very attractive in that aspect. One of the things I don't really love about the company is kind of my criteria for taking a long-term position. And that is, it has to have recently hit by bad earnings or news, and that's happened for sure. But it's got to be something that I actively use or I feel confident about the company. I just learned about this company about a day ago, and because of that, I don't have enough confidence in the company where if the stock got hurt by 20% in another earnings report, I wouldn't have the confidence to continue holding, even though it looks like it's probably a pretty good long-term investment. Something like Zynga, they have the apps and games that I know that people love, even though I don't play them. They have Farmville, Words with Friends, stuff that I know that is still out there and is actively being played. The stuff that they have on Glue, not as attractive for me, just because I don't have the confidence in the products that they're putting out. The charts can look great, which is why I love it for a swing trade, but for a long-term investment holding through earnings, I probably would not recommend that for myself. It's something where I'm trying to get in now, play the upward trend for a little bit, and then exit my position before the next earnings report comes out. With earnings, you have a lot of increased volatility. In the past, it's been hurt by earnings not doing as well as they've previously thought. The company still could be profitable in the long run. I do like it overall. I just don't want to be holding through the earnings in case something really negative comes out and the stock falls. On this channel, I talk a lot about looking at the competitors in the sector that you're trading. In the past, I've talked about Zynga, and now that we've talked about Glue today, you can really compare the two and kind of the attractiveness of the stocks overall. Swing trading, I like Glue a lot just because of how far it's fallen from its all-time highs in the past year. Zynga is still pretty much up at its 52-week high, but I like the company for a long-term play as well. It's got the consistency of very nice returns, and I feel more confident in the company going forward. More reliable trade would be with Zynga, but there's a lot more money to be made with something like Glue that's fallen so far from its highs. It's just you have to kind of consider the stock could continue to fall further as it's missed on earnings a couple times in a row, and that might continue. Or it might turn around and you make an incredible profit. It's all about figuring out how much risk you're willing to take on a position. If I was going with a larger account where I wouldn't feel confident holding through poor earnings and losing 20%, I'd probably go with something like Zynga. If I was looking to be super aggressive and try to make 20%, 30% in a couple months, Glue would be the type of company that I'd look at. It's had the track record of good performance besides the earnings reports recently, and I like the trend that it's done ever since it's fallen to its new lows. So overall, I think that Glue has an opportunity for pretty much any type of investor. It's not something I would be looking at personally because I don't feel confident enough in the product that it puts out. But if you're one of those people that plays the Kim Kardashian game or Diner Dash and you feel confident in the product that they're putting out, I would feel happy taking a position in Glue overall. So let me know what you think about Glue, ticker symbol GLUU, in the comment section down below. And if there's a video or just an idea you'd like me to go over in the future, please leave it in the comment section down below and I'll get to it as soon as I can. Thanks for watching this episode of Robinhood Top Stocks. I'll see you tomorrow for the next video. Thanks for watching.